In over 50 years of experience as an investor, Howard Marks has seen three major shifts in the stock market and economy, which he refers to as sea changes. He believes that the world is experiencing another sea change, which he considers a once-in-a-generation opportunity. The first sea change took place in the 1970s, where the focus shifted from avoiding risk to taking calculated risks. The second sea change was brought on by the actions taken by the central banks and treasuries worldwide in response to the 2008-2009 global financial crisis. This led to a period of favorable conditions for borrowers and asset owners, but Marks believes that this period has now ended and will not be the norm in the future. A period that has left devastating effects on people. The value of assets, such as stocks, bonds, and real estate, is determined by the cash flow that it generates for the owner, which is discounted back to the present day using an interest rate. Marks does not believe that the past 14 years since the financial crisis were a bubble, but rather a hyped, unusual good time for borrowers and asset owners. That is why, on InvestWise, we provide you with all of the information you need to be on time with your investments. If it is useful, please consider hitting the like button and subscribing. So, what will happen in 2023? Howard Marks believes that the world is experiencing a sea change in the stock market and economy, and he encourages investors to take advantage of this unique opportunity. By studying the world's best investors, he hopes to help others become better investors as well. It's important to understand that the stock market and economy are influenced not just by interest rates, but by many other factors as well. For example, inflation and economic growth also play a crucial role in determining the stock market's direction. Interest rates will likely rise when inflation is high and the economy is growing. That is because the central banks want to curb inflation and to slow down economic growth to avoid overheating. In this scenario, stocks prices may suffer as investors become wary of rising interest rates and their impact on their investments. However, it's also important to note that the stock market is not a one-way street. While the rising interest rates can be a headwind for stocks, but also create opportunities for savvy investors. For example, when interest rates rise, bonds become more attractive to investors as they offer a higher yield than stocks. This shift in investor sentiment can create opportunities for stock investors to take advantage of the market's overreaction and buy quality stocks at a discount. The relationship between interest rates and the stock market is complex and multifaceted. While rising interest rates can be a headwind for stocks, they can also create opportunities for investors who are able to navigate the changing landscape. As always, it's important to have a well-diversified portfolio and to stay informed about the various economic and market factors that can impact your investments. Additionally, it's important to remember that the stock market is a long-term investment and that short-term fluctuations, including those caused by changes in interest rates, should not be a primary concern for long-term investors. By focusing on the fundamentals of the companies you own and maintaining a well-diversified portfolio, you can weather the ups and downs of the market and achieve your financial goals over the long term. The stock market balances economic factors, including interest rates, inflation, and consumer confidence. Over the past several decades, the stock market has experienced significant ups and downs, often in response to broader economic events. What happens after the storm? The dot-com bubble of the 2002 led to a significant drop in the stock market by 22%. The Great Financial Crisis of 2008 resulted in another drop of nearly 37%. These events took place during the Great Depression, which was the worst economic downturn in the history of capitalism. The Federal Reserve has initiated raising interest rates to tackle inflation. The aim is to reduce inflation by controlling the balance between supply and demand. as low interest rates increase demand for goods and services as borrowing money becomes cheaper. For instance, if someone takes out a $400,000 30-year mortgage at a 7% interest rate, their monthly payment would be $2,661. However, if they take out the same mortgage at a 3% interest rate, the monthly payment would drop to $1,686, showing how low interest rates can increase demand. Experts believe that the Federal Reserve will eventually be able to control inflation and stop rising interest rates, but interest rates will likely not return to the low levels of the 2000s. Instead, they are expected to settle somewhere between the high interest rates of the 1980s and the low interest rates of the 2010s. Consider diversifying your portfolio by investing in different asset classes. Diversification is an important principle in investing because it helps spread risk and reduce the impact of any one investment on your overall portfolio. You can do this by investing in a mix of stocks, bonds, real estate, commodities, alternative investments such as private equity, hedge funds, and venture capital. Consider investing in high-quality companies with a strong track record of growth and profitability. Companies that have a solid history, steady growth, a solid financial position, and a competitive advantage in their respective industries are generally considered more stable investments. In addition, companies with a strong brand and reputation are often more resilient to economic downturns and can better weather market fluctuations. Aside from these tips, it's also important to consider your investment goals, risk tolerance, and time horizon when making investment decisions. For example, if you are saving for a short-term goal like a down payment on a house, you may not want to take on too much risk and prefer to invest in lower-risk instruments like bonds or money market funds. On the other hand, if you have a long-term time horizon and are willing to take on more risk, you may be more inclined to invest in stocks or alternative investments. Investing in the stock market can be a complex and challenging process, but with the right approach and strategy, it can also be a rewarding and lucrative opportunity. The key to your success is staying informed, doing your research, and being disciplined. This means regularly reviewing your portfolio, monitoring market trends, and making adjustments as needed. The best Howard Marks tips are these strategies to maximize your returns and minimize risk. Value investing, for example, which involves identifying undervalued stocks with growth potential, can be a good strategy for long-term investors. Growth investing, which involves investing in companies that are expected to grow quickly, can also be a good option for those who have a higher risk tolerance and a longer time horizon. Another strategy is to invest in index funds that have a track record of a broad range of stocks, bonds, or other assets. Index funds are often considered a low-cost, low-risk option for investors because they are typically passively managed and aim to track the performance of a specific market index. This can be a good option for those who are new to investing or for those who prefer a more hands-off approach. The investment landscape has changed dramatically in recent years, and investors need to stay informed and adjust their strategies accordingly. Considering the tips from Howard Marks and other investment strategies, you can maximize your returns and minimize risk, helping you achieve your financial goals. However, it's important to remember that investing always involves some level of risk and that past performance does not guarantee future results. It's important to do your research, stay informed, and consult with a financial professional to ensure that you make informed investment decisions. Build up a cash position. Historically, savings accounts offered little to no interest, resulting in a loss of purchasing power over time. However, with higher interest rates, keeping cash in a savings account can now earn a better return, making it a viable option for investors. Evaluating the opportunity cost of holding cash is important, as a higher interest rate reduces the opportunity cost and makes it more attractive to wait for the right investment opportunity. Prepare for investment opportunities that may arise in the next 12 to 24 months. As the new economy is rebounding, new opportunities may emerge, and investors should be prepared to take advantage of them by building up a cash position. Investing in the right opportunities can be challenging, especially with changing economic conditions. Investors must evaluate their risk-reward balance of their investments and consider investment options that may have been overlooked in the past. By diversifying investments, holding cash when necessary, and preparing for potential investment opportunities, you can make informed decisions that will help you achieve your investment goals. If you loved this video, subscribe, leave a like, and watch this one too.